Today we will discuss principle of insurance. So as far as principles of insurance is concerned, we will be discussing standard fire policy as per syllabus of IBBI. So here we will discuss what are the principles of insurance, what are the rights of the insured, and what are the obligations of the insured, and what are the obligations of insurer, and then we will discuss how to calculate the replacement value of a an asset for insurance purposes. So basic thing is there is that if you have taken insurance on declared value right declared value, then it is very much possible that in case of any loss you will be getting compensation as nearer to the loss as possible. If it is underinsured, then you will not get the proper compensation as per the loss, and if it is overinsured, then you will have to pay more premium than what you will be getting at the time of loss. So in we will discuss the theoretical portion, and then we will apply the learned principles in the case studies at the end of the videos. So as far as syllabus is concerned, syllabus principle of insurance and loss assessment. Here you have to discuss, learn principles of legal concept in relation to insurance of building, contract of insurance, insurable interest, liability to insure, duties of the insurer and insured, types of fire policies, reinstatement value, indemnity policies, and policies for other perils, terms and conditions, perils, beneficial and restrictive clauses. Then you have to study value at risk, sum insured, and condition of average, over and under insurance, revision regarding inflation, depreciation, obsolescence, and betterment, other provisions, preparation of claim, then obligations and rights of insurer and insured. As far as weightage is concerned, weightage is 3%. So first of all, we will discuss principles and legal concepts in relation to insurance of building. So first thing which is most important, it is principle of indemnity. So this principle ensured that the insured is compensated for the actual loss suffered. See here, the insured is compensated for the actual loss suffered, but not more. So the aim is to restore the insured the same financial position they were in before the loss occurred. So this is most important principle of insurance, that insured is compensated this thing for the actual loss suffered, but not more. See, remember. Next is principle of insurable interest. So here the main thing is that the insured must have a financial interest in the property. So what does this mean? It means the insured must be owner of the property, or he should have a legal interest in the property. Next is principle of utmost good faith. So in this case, see, both the insurer and the insured must act honestly and disclose all relevant information. So, as far as insured is concerned, he must provide accurate details about the property. And as far as insurer is concerned, he must clearly explain the policy terms. Then legal concept involved in it are subrogation. So what is subrogation? So it allows the insurer to take a legal action against a third party responsible for the loss. So what does this mean? We will try to explain this thing with an example. For example, if faulty wiring caused a fire, the insurer could sue the electrician. So this is subrogation, that the insurer has the right to take legal action against the third party. Then contribution. If there are multiple insurer policies, if a person is having multiple insurance policies covering the same loss, each insurer will pay a proportionate share based on coverage provided. So if the person, instead of a single policy, he has multiple insurance policies for the same loss, then in that case each of the insurer will pay a proportionate share based on coverage provided. Then proximate cause. So this is the most important thing, that primary cause of loss must be covered by the policy. See here, the primary cause of loss must be covered by the policy for the insurer to be liable. For instance, if a fire caused a faulty wiring, damage a building, the insurer will pay repairs only if policy cover the fire damage, otherwise it will not do so. Next is contract of insurance. So what is contract of insurance? It is a legally binding agreement between the insurer and the insured. So as you know, what is contract? So same definition is applied here. It is a legally binding agreement between insurer and the insured. So same term agreement as there is in the contract. So the insurer promises to indemnify the insured against the specified risk. So here only the specified risks are indemnified in exchange of a premium. So the insured must have an insurable interest in the property being insured. So as we have already discussed it, that the insured person must be owner or must have some legal right in the asset of which he is getting insured. So he must have an insurable interest in the property being insured. Next, what are insurable interest? So insurable interest is a fundamental requirement of any insurance policy. It means that insured must have a financial stake in the property being insured. So already discussed. So for an example, a homeowner has an insurable interest in their house because they would suffer a financial loss if it were damaged or destroyed. Then next thing is liability to insure. So what is the liability to insure? It refers to the responsibility of the insured to disclose all the relevant information to the insurer and to take reasonable steps to prevent losses. So the insurer must in terms is liable to compensate the insured for the covered losses. So this thing is most important, that it does not mean that if you have got policy and you can do anything. You have to take reasonable steps to prevent losses. So if you have taken, let us suppose for example, you have taken policy for against theft in a house, so it does not mean that you will not lock your house or you will not take care that thieves can enter the house at any time. So you must provide do reasonable steps, take reasonable steps to prevent losses. And the insurer, in terms, is liable to compensate the insured for covered losses. Now we will discuss what are the duties of the insurer or the insured. So, what are the insurer's duties? So, the insurer must act in good faith, provide clear information about the policy, and promptly investigate and settle claims. These are the duties of the insurer. So he must act in good faith means he must give all terms and conditions at the time of insurance. And then what are the duties of insured? The insured must provide accurate information about the property. First thing. Second thing, he must pay the premium on time. And third thing, he should take reasonable steps to prevent losses. Then types of insurance, fire insurance. So basically, as you know in the syllabus, you have to study standard fire insurance. So we will discuss types of fire insurance policy. First type is standard fire insurance plan. It covers damages caused by fire, lightning, explosion, and implosion. Four things are involved. It covers damages caused by fire, lightning, explosion, and implosion. The next step is fire indemnity plan. It focuses on providing coverage that matches the actual financial loss suffered by the insured. So third thing is valued policy. It covers fixed value assets like historical buildings, antiques, and artifacts. Then replacement value policy. There are two types of policies. First is replacement value policy, and next is reinstatement value policy. So in replacement value policy, pays the replacement value of the damaged asset minus depreciation. See here word minus depreciation in case of replacement value policy. And in case of reinstatement value policy, it covers the lost cost to restore the damaged property to its pre-loss condition. Pre-loss condition. So there are two types of policies you must remember: replacement and reinstatement. So in case of replacement, you have to find out replacement value minus depreciation. So what is reinstatement value? The reinstatement value clause ensured that insurance company pays the cost to restore damaged property to its original condition using similar materials and quality. This clause encourages property owners to build rather than just pocketing the depreciated value. So this is reinstatement value. Means in case of replacement value, you have to find out depreciated replacement cost of the building at the time of loss. But in case of reinstatement value, you have to find out reinstatement using similar materials and quality. This thing you must ensure. Then indemnity policies. Foreign insurance policies operate on the principles of indemnity, meaning insured will be compensated for their loss up to a certain limit. See here, up to a certain limit, subject to maximum sum insured. The aim is to place the insured in a same financial position after the loss as they were before the occurrence of the loss. So this thing will be clear when we will be studying case studies at the later part of our video. Then policies for other perils. So you can take policies for other perils also. Fire insurance policy can also cover other perils such as, so in case of fire policy, These things are already covered in it. Lightning, explosion, bursting of overflowing of water tanks, natural disasters leading to fire outbursts. So these can also things can also be covers. These perils can also be covered in standard in fire insurance policies. Then terms and conditions. So terms and conditions of fire insurance policies typically include insurable interest. So policy or we have already discussed that policy or holder must have an insurable interest in the subject matter of the insurance contract both when purchasing the policy. See here, he must have insurable interest at the time of purchasing a policy and at the time of loss. Then warranties. What a warranty is implied? It implies that insured must adhere to such a maintaining safety standard. So this thing we have already discussed. Then exclusions. What things are excluded? Specific perils or circumstances that are not covered by the policy. So, so what are perils? Perils. So perils in fire insurance refer to the events or causes of loss that are covered by the policy, such as fire, lightning, explosion, and implosion. These are called perils of the policy. The terms and condition of fire policy typically include insurable contract. So the holder must have an insurable interest in the subject matter of the insurance contract. See here, this must be at the time of purchasing the policy and at the time of loss. What are pairs warranties? Warranties are that insured must adhere to, such as maintaining safety standards. So, what things are exclusion? What are exclusion? Specific perils or circumstances that are not covered by the policy. Then, what are perils? Perils are in insurance refers to the event or cause of loss. These are basically cause of loss that are covered by the policy, such as fire, lightning, explosion, and implosion. So, beneficial and restrictive clause. Beneficial clause, it provides additional benefits to the insured, such as reinstatement value clause. As we have already discussed, what is reinstatement? This is beneficial. So there are some clauses which are restrictive clauses. So what are restrictive clauses? Clauses that limit the insurer's liability, such as exclusion of certain perils or circumstances which are not included in the policy. Then value at risk. What is value at risk? Value at risk is a statistical measure to assess the potential loss in value of the portfolio or asset over a specific period of time, given a certain confidence level. It is commonly used in financial institutions to manage and control risk exposure. So, we will discuss it in case studies also. Then, next thing is sum insured and condition of average. What is sum insured? Sum insured is a maximum amount that an insurance policy will pay out in the event of a claim. This is a maximum amount which the insurance policy will pay in the event of a claim, in the event of a loss. Then, what is condition of average? It is also called pro rata condition of average. It applies when the sum insured is less than the actual value of the insured policy. In such cases, claim payout is reduced proportionately to the degree of underinsurance. So, in the case studies, we will we discussing this thing, what is under insurance and how it affect the compensation and how the condition of average is applied. We will discuss these things in the case studies in the later part of this video. Then we have studied under insurance, then there is one term over insurance. So now we will discuss what is over insurance and what is under insurance. So over insurance occurred when the insured value, see here, when the insured value exceeds the actual value of the property, and when the insured value is less than the actual value, then we call it under insurance. So what is the effect of over insurance? It leads to unnecessary high premiums. And what is the effect of under insurance? It results in reducing claim payouts. See the difference. Next, provisions regarding inflation, depreciation, obsolescence, and betterment in the policies. So, inflation, to curb this thing, what policies do in the policies we do, insurance policies may include provisions to account for inflation, ensuring that the sum insured remains adequate over the time. You know, you take the policy for a certain period of time, for 1 year or 2 years or 3 years. So during this period, the value of the asset may increase due to inflation and other related things. So in order to take care of it, so we have to include some provisions for this inflation. Why? To ensure that insured remains adequate over the time. So depreciation. So depreciation accounts for, what is depreciation? It accounts for a reduction in the value. First thing is, it is reduction in the value. Reduction in the value of an asset over time because of steps to prepare claim. So first thing is immediate notification. You notify your insurer as soon as possible after the damage occurs and provide initial details about the incident and extent of damage. Then document, you should gather all the necessary documents and submit it to the insurance company. First document is proof of loss. So you should provide a detailed description of the damage and circumstances leading to it. Then you should provide photographs and videos for visual evidence of the damage, and then you should provide receipt and invoices for any repairs and replacement already made. In case of theft or vandalism, you may have to provide copies of police reports or FIR. Then if there were any witnesses to the incident, you may have to provide their written statement. Then you have to provide a formal claim letter. You should draft a formal claim letter to your insurance. It should include all the details such as date of incident, time of incident, description of damage, and any supporting documentation required. Then you have to fill out a claim form which will be provided by your insurer. Ensure that all the information is accurate and complete. Inspection. The insurer may send an adjuster to inspect the damage and assess the claim. Be available to provide any additional information or documentation required. So the insurer will send some engineer or surveyor to inspect the damage and assess the loss for the claim. And you should be available to provide, and you should be able to provide any information and documentation required. Then obligations of and rights of the insured and insurer. So obligation of the insurer, we have already discussed it. Good faith and fair dealing. Obligation is the insurer must act honestly and fairly in all dealings with the insured. For example, providing clear information about the policy terms and conditions, avoiding misleading statements. Should not provide give any misleading information or statement. They should try to process claims within shortest possible time. So this is timely claim processing. So this is the obligation of the insurer that they must process the claims promptly and efficiently. For example, reviewing and a settlement a fire damage claim within a stipulated time frame. Next, disclosure and exclusions. Obligation. The insurer must clearly disclose any exclusions or limitations in the policy. For example, informing the insured that damage from wear and tear is not covered. Then payment of valid claims. So this is the obligation of the insurer that they must pay all valid claims as per the policy terms. For example, compensating the insured for theft of insured property. So now we will discuss what are the rights of the insurer. First we have discussed obligation. Now we will discuss what are the rights of insurer. Rights of premium. So he has the right to receive the premium payments as agreed in the policy. For example, receiving annual premium payment for a health insurance policy. Then he insurer has a right to investigate claim. So they can investigate claims to ensure they are valid. So inspecting a damaged car before approving the repair claim. Then right to subrogation. We have already discussed that insurer can pursue recovery from a third party responsible for the loss after compensating the insured. For example, suing a negligent driver who caused an accident after paying the insured's claim. Then right to cancel policy. The insurer can cancel the policy if required or if insured person breaches the terms. For example, cancelling a policy due to non-payment of the premium. Now we will discuss obligations of the insured. So we have already discussed disclosure of information. So this is the obligation of the insured that he must provide accurate and complete information when applying for insurance. For example, disclosing any pre-existing medical condition when applying for an health insurance. Then payment of premium is the obligation. He must pay the premium at right time to keep the policy active. For example, paying annual premium for a home insurance policy. Then mitigation of loss. This is obligation that he must take reasonable steps. We have already discussed. He must take reasonable steps to prevent further loss or damage. For example, taking immediate actions to stop a water leak to prevent further damage to the property. Then prompt notification of claim. So in case of any loss, insured must notify the insured promptly for any loss or damage. For example, reporting a stolen car to the insurer immediately after discovering the theft. Then what are the rights of the insured? Right to fair treatment. The insured is entitled to fair and honest treatment by the insurer. For example, receiving clear explanation of the policy coverage and claim decisions. Right to claim compensation. So it is a right of the insured to claim compensation for covered losses. For example, filing a claim for fire damage to a house, and receiving compensation according to the policy terms. Then right to information. So the insured has all the rights to receive all the relevant information about the policy and the claim process. For example, being informed about the steps involved in filing a claim and the documentation required. Right to appeal. So insured has the right to appeal against unfair claim decision. For example, contesting a claim denial by providing additional evidence and requesting a review. So, what the standard fire policy covers? These are cover. This is a package insurance which covers following steps of perils generally. Standard fire policy of many companies. They cover fire, lightning, explosion, aircraft damage, riot, strike, malicious damage. These are called RSMD perils. Then storms, tempest, flood, inundation, hurricanes, cyclone, typhoon, and tornado. Then impact by any railroad vehicle or animal belonging to third parties. Subsidence, landslide involving rock slide, bursting and overflowing of water tank and apparatus, leakage of automatic sprinkling installation, missile testing operation, pollution or contamination resulting from any of the above perils, any insured peril resulting from pollution and contamination, bushfire, the, then we can have additional inbuilt cover also. Architect, surveyors, and consulting engineers fees up to 3% of the claim amount. Expenses incurred for removal of debris to clear the site up to 1% of claim amount. Machinery and equipment temporarily removed from repairs, cleaning, renovation of other similar purposes for a period of 60 days. So, in many policies, STFI and RSMD pearls can be deleted at the inception of the policy, for which suitable reduction in premium rate is allowed in some cases. Fire policy is an annual policy in many cases. So long-term fire policy for a minimum period of 3 years is also available for dwellings only, with suitable discounts in premium. So generally fire policy is annual policy, but we can have long-term policy for a minimum period of 3 years. So covers for SFI RSMD pearls can also be given during currency, where they are deleted at the inception of choice in special circumstances. So sum insured, we have already discussed what is sum insured, and we will discuss how the sum insured is calculated. First we will calculate the replacement cost, and then what we will do, we will generally increase the sum calculated, so may be increased up to 25% maximum by opting for escalation extension. So we will discuss all these things, that how the compensation is paid. So for example, if the declared sum of insured is found to be less than the value of property insured, as in case of under insurance, let us suppose the value of the property is 50 lakh and the sum insured is 40 lakh. The fire loss is 10 lakh. So what will be the claim amount? See here, at present, at the time of loss, the value of the property is 50 lakh. But at the time of taking insurance, the value of the property was 40 lakh. So it is a case of under insurance. So in this case, full loss of 10 lakh will not be given by the company. So it will be reduced proportionately. How it is reduced? So we will it will be we will calculate under insurance coefficient, which is 40 upon 50. This is that sum insured divided by the actual value of the property, 40 upon 50, multiplied by the loss 10 lakh. So instead of 10 lakh, the owner will get 8 lakh in case of any loss. So we have already discussed that we can have policy on completed depreciated value basis or estimated cost of reinstatement, which is material plus labor as on the date of insurance plus suitable escalation for policy period minus depreciation for age. So this is completed depreciated value policy. But in case of reinstatement, you have to calculate the reinstatement value, means the cost of labor plus material of similar property as on the date of proposal plus suitable escalation for policy period. So here this, in case of reinstatement policy, this reduction is not done. Depreciation for age is not done. So we will discuss it in the case studies. So this thing we have already discussed, that what is under insurance coefficient. So it is sum insured at the time of policy divided by the value of the asset at the date of claim. So how much claim you will get? It will be value assessed as loss or damage multiplied by the under insurance quotient. So as in the case first example we have done, this is a value assessed as loss 10, this is 40 sum insured at the time of taking policy and 50 lakh at the time of loss. So this way you can use to calculate claim payable. Next, what is policy excess? So this is basically in case of, you should not confuse it with the term excess. This is the amount you have to pay if you decide to make a claim on your policy. So many times this is just we may call it as service charges, but at the time of taking a claim, the insurance company will charge you some amount, as in the form we can say service charges, which is in technical terms it is called policy excess. So many companies take these at the time of claim, or many times they can take with the premium this value of policy excess. So this was the theoretical portion. Now we will discuss all the things which we have discussed in some case studies from now onward. Assess the claim payable for a partial loss of by fire or to an old factory building built in 2050. Actual damage by the fire is estimated as 12 lakh. Standard fire policy is taken for 25 lakh. Factory built up area is 700 square meter and replacement cost or date of damage in 2025 is 16,000 per square meter. Assume foundation as 10%. Life of the property may be taken as 40 years. So here one thing you have to remember. We have to calculate only the cost of superstructure. At the in case of when you are calculating value for depreciated replacement cost in case of insurance, you have to calculate only the cost of superstructure only. Means the cost of foundation is not to be taken. cost of foundation is not to be taken in case of insurance. So what he has given? He has given the cost of foundation as 10%. So how to proceed in this case? See here, replacement cost 700 square meter is the area, 1600 per square meter is the rate. So the replacement cost of new building, if you have to construct a new building in 2025, replacement cost will be 700 into 16,000, 1 crore 12 lakh. See here, we have already discussed that cost of foundation is not to be taken. So here he is given cost of foundation as 10%. So cost of foundation and plinth 10% means you have to deduct 10% of 1 crore 12 lakh, which is 11 lakh 20,000. So the net cost of superstructure. So already we discussed that we have to take only cost of superstructure. So 1 crore 12 lakh minus 11 lakh 20,000, it will be 1 crore 80,000. Age is given to you as, see here, 20 years. Life is given to you as 40 years, suppose, and salvage value is nil. So generally in case of insurance, salvage value is taken as nil. So here it must be for the age, here it must be 2005 instead of 2015. So always we take as nil, mostly in case of insurance it is assumed to be nil. So depreciation, you know, formula is age divided by life into 100%. So 50% has depreciated. So the depreciated cost, this is the net cost, depreciated cost will be 50% of 1 crore 80,000. So it will be 50 lakh 40,000. So it was insured for 25 lakh only, and the value at the time of, see, at the time of loss, depreciated value is 50 lakh 40,000, and he has taken the policy for 25 lakhs only. So it is a clear cut case of under insurance. So average clause of the policy will therefore will be applicable. So the formula, you know, it is sum insured at the time of policy divided by value at the time of loss. So 25 lakh divided by 50 lakh 40,000 multiplied by 100. So percentage of under insurance is 49.60%. So actual loss covered is suffered is 22 lakh, 12 lakh. So claim payable is 49.6, means 0.496 into 12 lakh, 5 lakh 95,200. So instead of 12 lakh, see here, he will be getting only 5 lakh 95,200. So approximately a loss of 6 lakh. So we'll be taking another example. RCC roofed building 25 years is required to be insured under a standard fire policy. Otherwise, fair insurable value of the proper factory building on depreciated cost basis. So here we have to calculate it on depreciated cost basis. It is given plinth area of the factory at ground floor 600 square meter, at first floor 400 square meter. Replacement cost today 7,000 17,500. Age of the building is 25 years. Total life of the building is 60 years. Foundation is given as 10%. So this is the data which is given to you. So total built up area will be 600 plus 400, 1000 square meter. Total replacement cost 1000 into 17,500. It will be 1 crore 75 lakh. So less 12% of cost of foundation 17 lakh 50,000. So net replacement value 1 crore 57 lakh 50,000. Age is 25 years, life is 60 years, salvage we assume as nil. So depreciation will be 25 upon 60 into 100. So depreciation is 41.66. So depreciated value will be 41.66% of 1 crore 57 lakh 50,000. It will be approximately 65 lakh 61,000. So what we can do would to take care of factors like increase in prime cost, exchange rate, etc. during the currency period of the policy, the corresponding sum we may increase up to 25%. So we advise him to increase it by 25% of 65 lakh 61,000. So instead of taking insurance for 65 lakh 61,000, he may take it for 82 lakh so that he is able to get full compensation at the time of loss. So next, a standard fire policy with reinstatement clause was taken for 261 lakhs for effective roof of 1700 square meter for 25 years old. Replacement cost is 22,000 per square meter. Fire loss is 50 lakh. Assume life as 60 years. Salvage value is given as nil. Plinth and foundation as 15%. So claim payable is how much, and if the policy excess is to 10,000 is to be considered, then what is the claim payable? So sum insured is 2 lakh 61,000. It is given area of the building 1700 square meter, age of the building 25 year. Replacement cost is given to you, fire loss is given to you as 50 lakh. So life is 60 years, salvage value is nil, plinth and foundation 15%. So special clause it is reinstatement value. So in case of reinstatement value, you don't have to take depreciation into account. This is the area, this is the replacement rate. So the replacement value will be 1700 into 22,000, 3 crore 74 lakh. Age of the building is 25 years, life of the building is 60 years, salvage value is nil. So reinstatement value of the building you have to calculate. So you have to take only 15% of less foundation. So depreciation not is to be considered, but cost of foundation is to be deducted. So cost of foundation 15% means 85% of 3 lakh crore 74 lakh. So it will be 3 crore 70 lakh 90,000. So the factory was insured for 261 lakhs, and the cost is as on the date of loss is 3 crore 17 lakh 90,000. So under insurance coefficient is 82.1%. Actual loss is 50 lakh. So claim payable will be 82.1% means 41 lakh 5,000 instead of 50 lakh. So this is all about principles of insurance. So if you have any query, you may get directly to cev.ac.org, or you may contact directly to the CEV. Thank you very much. Have a nice day. Thank you.